Hey there, future homeowners. If you've ever thought about buying a house, chances are you've heard this advice: you need a 20% down payment. But here's the thing, that's not true. In fact, believing in this outdated rule could be holding you back from owning your dream home. For decades, the idea of putting down 20% has been passed around like some sacred truth. But did you know that most first-time buyers today put down far less than that? According to the National Association of Realtors, only 27% of buyers make that big of a down payment, while the majority use smaller down payment programs to get into the market earlier. So, why do people still cling to this myth? And how can you avoid falling into the same trap? In this video, we're going to break down the 20% down payment myth and explore smarter, more flexible options available today. We'll show you how buyers are purchasing homes with as little as 3% down, how some buyers avoid down payments altogether, and the hidden costs of waiting to save 20%. By the end of this video, you'll have all the knowledge you need to buy your home sooner, save money, and avoid costly mistakes. Whether you're a first-time buyer or just curious about the process, stick around. This might just be the push you need to start your homeownership journey. Origins of the 20% down payment rule. Let's take a step back and explore where the 20% down payment rule came from and why it still persists today. Believe it or not, this idea dates back to post-World War II lending practices, when banks wanted to protect themselves from high-risk loans. Back then, lenders required a 20% down payment as a way to reduce their exposure to potential defaults. This hefty down payment gave lenders confidence that the buyer had enough skin in the game and wouldn't easily walk away from the loan. But things have changed dramatically. With modern mortgage programs and government-backed loans, the rigid 20% rule has become outdated. Yet, it still lingers, influencing how people approach home buying today. Many potential homeowners believe they need to save 20% of the home's value to qualify for a loan, leading them to postpone their homeownership dreams for years. Here's the reality: you don't need to wait for 20% down. The National Association of Realtors reports that most first-time buyers put down between 3% and 10%. However, because this myth has been deeply ingrained, it continues to discourage many from entering the housing market sooner. Even in today's market, the 20% rule myth lives on due to outdated financial advice and fear of private mortgage insurance, PMI. But PMI isn't the burden people think it is, and most loan programs offer ways to reduce or eliminate PMI over time. The key takeaway here: the 20% down payment is just a guideline, not a requirement. Flexible loan options mean you can buy a home with much less money up front, and still build equity over time. The drawbacks of saving 20%. Waiting to save a 20% down payment might seem like the responsible thing to do, but it can actually cost buyers more in the long run. One major drawback is opportunity cost. Home prices in many areas increase by 4% to 6% annually. If you're trying to save an extra $40,000 over several years, the value of the home you want could rise by $50,000 to $80,000 during that same period, making it even harder to afford. There's also the issue of mortgage interest rates. Rates are constantly changing, and by the time you've saved the full 20%, interest rates may have gone up. A higher interest rate on a loan can increase monthly mortgage payments, wiping out any benefit you might have gained by waiting for a larger down payment. A real-world example illustrates this well. Alice decides to wait 5 years to save a full 20% down payment on a $400,000 home. Meanwhile, Brian purchases the same home with a 5% down payment and benefits from the property's annual appreciation. By the time Alice buys, the home has appreciated to $500,000, while Brian's equity has grown with it. On top of that, Brian started paying down his loan 5 years earlier, giving him a head start in building wealth through real estate. Another often overlooked factor is inflation. As you wait and save, inflation gradually reduces the purchasing power of your savings, making the down payment target feel like a moving goalpost. For many buyers, it's better to get into the market sooner with a smaller down payment, benefit from rising home values, and refinance later to better terms when they've built equity. The cost of waiting extends beyond just money. It delays homeownership, depriving you of potential tax benefits, stability, and the chance to build wealth through real estate appreciation. In many cases, making a smaller down payment and locking in a home today can result in more savings than trying to reach the elusive 20%. Loan options with lower down payments. The good news is that you don't need 20% down to get a mortgage. Today, there are several loan programs designed to make homeownership more accessible. Some of these options require as little as 3% to 5% down, and a few even offer zero down payment options. Understanding these alternatives can help buyers enter the market sooner and avoid the unnecessary burden of waiting for a larger down payment. FHA loans. 3.5% down payment. FHA loans are backed by the Federal Housing Administration and are especially popular among first-time buyers or those with lower credit scores. With an FHA loan, buyers can secure a mortgage with a down payment as low as 3.5%. For example, on a $300,000 home, that's only $10,500, a far cry from the $60,000 required under the 20% rule. FHA loans do require mortgage insurance premiums, MIP, but the trade-off is easier qualification standards compared to conventional loans. Conventional loans. 3% to 5% down payment. Private lenders now offer conventional loans with down payments as low as 3% to 5%. While these loans generally require a higher credit score, they provide more flexibility than FHA loans. Borrowers making less than a 20% down payment will need to pay for private mortgage insurance, PMI, but unlike FHA loans, PMI can be cancelled once the borrower reaches 20% equity in the home. For a $400,000 home, a 3% down payment means just $12,000 upfront. VA loans. 0% down payment for veterans, active duty service members, and eligible spouses can access VA loans, which require no down payment. These loans also come with the added benefit of no mortgage insurance requirements. In 2023, 10% of all mortgages issued were VA loans, highlighting how popular they've become among those who qualify. With competitive interest rates and no PMI, VA loans are one of the best options for those eligible. USDA loans. 0% down payment for rural buyers. The USDA loan program offers another path to homeownership with zero down payment. These loans are intended for buyers in rural or suburban areas, though many people are surprised to learn that 90% of the US qualifies as rural under USDA guidelines. On top of offering low or no down payment options, USDA loans also feature low interest rates and flexible credit requirements. Each of these loan programs comes with its own set of conditions, but the bottom line is clear: buyers no longer need to wait until they've saved 20% to purchase a home. Programs like FHA, VA, USDA, and conventional loans provide more affordable and accessible pathways to homeownership, allowing buyers to get into the market without putting their financial future on hold. Trade-offs of a lower down payment. While lower down payment options make homeownership more accessible, they come with trade-offs that buyers need to be aware of. Understanding these trade-offs can help you make informed decisions about the right mortgage strategy for your situation. Higher monthly payments. A smaller down payment means you're borrowing more money, which translates to higher monthly mortgage payments. For example, with a 20% down payment on a $400,000 home, you'd borrow $320,000. But with a 5% down payment, you'd borrow $380,000, increasing your monthly payment. While this may seem like a disadvantage, getting into the market sooner often outweighs the higher monthly cost because of rising property values. Private mortgage insurance, PMI. If you put down less than 20%, private mortgage insurance, PMI, will likely be required. PMI protects the lender in case the borrower defaults on the loan. The cost of PMI typically ranges between 0.5% and 1% of the loan amount annually, which adds to your monthly payment. However, the good news is that PMI isn't permanent. Once you've built 20% equity in the home, you can cancel PMI, which reduces your monthly expenses. Higher interest rates. Lenders often charge slightly higher interest rates on loans with smaller down payments to offset their increased risk. Even a difference of 0.25% in the interest rate can impact the total amount of interest paid over the life of the loan. However, buyers can refinance to a lower rate later once they've built equity and improved their credit profile. The benefits outweigh the drawbacks. Despite these trade-offs, many buyers find that the benefits of buying sooner outweigh the costs. With rising property values, even a slightly higher monthly payment can result in long-term gains through home appreciation. Additionally, PMI cancellation and future refinancing provide ways to reduce costs over time. For many, it's better to enter the housing market now with a smaller down payment than to wait for the elusive 20%, only to face higher home prices and interest rates later. Creative solutions: house hacking and down payment assistance for buyers who want to reduce housing costs or eliminate down payment barriers. There are creative strategies that can make homeownership even more affordable. Options like house hacking and down payment assistance programs are becoming increasingly popular among savvy buyers looking to get into the market faster. House hacking: turn your home into an income stream. House hacking involves buying a multi-unit property, such as a duplex, triplex, or fourplex, and living in one unit while renting out the others. The rental income can offset your mortgage payments, sometimes covering the entire monthly payment. This strategy not only makes housing more affordable but also allows you to start building equity immediately. Even if you purchase a single-family home, renting out extra rooms or converting a basement into a rental unit can help reduce your financial burden. For example, if your mortgage payment is $2,500 per month and you rent out a unit for $1,500, your effective monthly cost drops to $1,000. This strategy can fast-track homeownership and increase your cash flow, all while building long-term wealth through real estate. Down payment assistance programs: unlocking support. Many local governments and organizations offer down payment assistance programs for first-time buyers or those with moderate incomes. These programs can provide grants, forgivable loans, or deferred payment loans to help with down payments and closing costs. Some states, like California, offer up to 5% of the home's purchase price in assistance, significantly reducing the upfront costs. Other programs provide tax credits or lower interest rates, further easing the financial burden for new homeowners. Many buyers who qualify for these programs don't realize they exist, which is why it's essential to explore state and local resources early in the home buying process. Maximizing opportunities: combining strategies like house hacking with down payment assistance programs can dramatically lower the cost of homeownership. With these tools, buyers can enter the market sooner, reduce financial stress, and start building equity immediately, without needing to hit the 20% mark. Does a 20% down payment always make sense? Contrary to popular belief, saving 20% for a down payment may not always be the smartest financial move. In fact, waiting to save that much could leave you worse off in several ways. One major issue is the opportunity cost. With home prices appreciating year over year, by an average of 5% nationwide, waiting to save a larger down payment could result in paying tens of thousands more for the same property down the line. There's also the risk of interest rate hikes. Mortgage rates fluctuate based on the economy, and waiting just a year could mean getting stuck with a higher interest rate, resulting in higher monthly payments. For instance, a 1% increase in interest rates can raise the monthly payment on a $300,000 loan by more than $150 per month. So even if you save a larger down payment, a higher interest rate could offset any savings, leaving you in the same or worse financial position. Some financial experts argue that manageable debt isn't always a bad thing, especially when it's tied to an appreciating asset like real estate. Taking on a mortgage with a smaller down payment allows buyers to enter the market sooner and capitalize on rising home values. If the property appreciates by 5% annually, your equity grows regardless of how much you initially put down. Meanwhile, rental costs continue to rise, meaning buyers who delay homeownership may end up spending more on rent, further limiting their ability to save. Another consideration is inflation, which erodes the value of money over time. Waiting several years to save 20% means your savings could be worth less in real terms, while home prices and interest rates move further out of reach. For many, it's better to secure a property now with a smaller down payment and refinance later when they've built equity and the market conditions improve. The flexibility of modern loan programs offers a smarter alternative to the 20% rule, giving buyers the chance to achieve homeownership sooner while minimizing financial risks. Finding the right strategy for you when it comes to buying a home, there is no one-size-fits-all approach. While the idea of saving a 20% down payment has been widely accepted for years, it's not the only path to home ownership. Modern mortgage programs, such as FHA loans, VA loans, USDA loans, and conventional loans, offer flexible solutions that allow buyers to enter the market with less upfront cash. Waiting to save 20% can mean missing out on home appreciation, facing higher interest rates, and losing the opportunity to start building wealth through real estate. Choosing the right strategy means balancing your financial situation, lifestyle goals, and market conditions. For some, leveraging house hacking or exploring down payment assistance programs will unlock faster access to home ownership. For others, making a smaller down payment and working toward equity through refinancing might make more sense. The key is to stay informed about your options and avoid letting outdated financial myths dictate your decisions. Getting into the housing market sooner, even with a smaller down payment, can often result in greater long-term financial benefits. Whether it's avoiding rising rental costs, capitalizing on home appreciation, or taking advantage of low interest rates, buyers today have more opportunities than ever to make homeownership a reality. If this video helped you understand the truth about down payments and how to navigate the home buying process, don't forget to like this video and subscribe to the channel for more real estate insights. We post videos that break down complicated financial topics, making it easier for you to make smart decisions. Also, let us know in the comments, what's your biggest hurdle when it comes to saving for a home? Have you explored any low down payment programs or considered house hacking to reach your homeownership goals faster? We'd love to hear about your experiences. And don't forget to turn on notifications so you never miss out on helpful content that can make your home buying journey smoother and more successful.